Welcome to the webinar of Switzerland Global Enterprise on the Swiss Corporate Tax Reform 3. We're very proud to have here with us two experienced experts on taxation consulting. And this is Armin Marti, partner at PricewaterhouseCoopers, and Laurent Schneider, director at PricewaterhouseCoopers. Very welcome. Before we start with the webinar, I would like to come to a few organizational topics. If you want to increase your screen, please press here. If you want to decrease, please press here. At the end of the session, we will have also the possibility to have a question and answer session. Please, while presenting, use the chat functions frequently. We will try to do that during, but especially also after the presentation of the two experts. So now I would like to give the floor to Mr. Martin.
Thank you, Liv Minder. Thank you, Switzerland Global Enterprise, for hosting us for this webinar regarding the status of Corporate Tax Reform 3. We at PwC, we have been working quite intensively behind the scenes in technical working groups together with representatives from the federal tax authorities, the cantonal tax authorities, from academia and representatives of some selected Swiss enterprises to craft the package of Tax Reform 3. Given the audience for this webinar is quite diverse, and given that we are hosted by a Swiss economic development agency, it will not be a deep dive in all the latest tiny tax technical details of the reform, but we will concentrate on giving you the highlights of the key measures of the reform, and we will try to put them into perspective, what they mean in the international context and what they mean for Switzerland as a business and tax location, particularly its attractiveness internationally. I would like to take the summary and conclusion up front. Switzerland with Corporate Tax Reform 3 will foster its position as the single most attractive business and tax location in Switzerland. Not in Switzerland, I should say, in Europe and even beyond. But let's go and start with the beginning. In order to put things into perspective, it is worthwhile to set the scene starting with the international environment, with the international developments that shape the international tax landscape, and obviously also influence still the Swiss reform. You see here two important constituencies, the OECD and the EU. You are well aware of it, obviously, of the 15 OECD BEPS action plan and reports which have overwhelmed us late last year, in autumn last year. The OECD aiming to create a level playing field amongst countries when it comes to compete for tax revenues. You also see the EU having been at the forefront of the tax dispute with Switzerland, which was the root cause of actually our reform today, which is taking significant influence in the shaping of the landscape, the international tax landscape, not only in Switzerland, but obviously also in the EU itself. The EU claimed that Switzerland, with the current tax system and its preferential tax status at cantonal level, violates the free trade agreement of 1972. It took them about 30 years after signing of the free trade agreement to figure that out, which to me speaks a bit for itself. Nevertheless, obviously, Switzerland had to face this pressure from the EU and had to give in with the signing of a memorandum of understanding in October 2014. That memorandum of understanding, in that Switzerland commits itself to abolish the corporate tax privileges at cantonal level, and foresees the transformation into a new world tax system that is in line with international requirements. After a lengthy debate behind the scenes, and eventually also in the Parliament, in the two chambers back and forth, on 5th of June, the package was sealed and signed by the two chambers and released to the public. But before we go into more details regarding the reform, just to recall you the major supranational developments at OECD and EU level. Obviously, there's a comprehensive set of things, but the key elements are obviously the 15 action plan in the BEPS program of the OECD, with the main goals to achieve avoidance of double non-taxation of income, eliminating hybrid structures, but also eliminating preferential selective tax regimes like the Swiss cantonal holding, mixed and auxiliary status. And at the same time introduce common rules for the remaining special tax regimes like the patent box. The clear stated objective of the OECD is also to create a system that will align taxation with the place where the value is actually created internationally. This is a topic particularly for the actions 8 to 10, the transfer pricing actions. And last but not least, perhaps even most important, is the creation of increased transparency in the field of taxation with the introduction of country-by-country tax and other key financial data disclosure requirements, and the introduction of spontaneous international exchange of tax information, in particular of tax rulings. The EU has not stood still, but embraces the OECD program and pushes it a step further with the Anti-Tax Avoidance Directive. The Anti-Tax Avoidance Directive was finalized and released before the summer break, and it asks the EU countries to implement various BEPS-related measures within a time frame until 2019. That's one aspect in view, that's the legislative developments. The other one is the fight for tax revenue by means of attacking illegal fiscal state aid. And I don't think I need to sort of go into great detail. You all have seen the bold press coverage, media coverage of the EU Commission's Apple decision last week, with requesting Ireland to collect from Apple 13 billion of taxes which the EU Commission claims Apple has not sufficiently paid in Ireland. It will be interesting to monitor this case going forward, because it has created quite some tension between the Americas and the European Commission, and it will also be interesting from a technical perspective to see how the European Court of Justice ultimately will deal with that case when it renders its final decision in about 2 to 3 years' time from now. So with that, I just wanted to illustrate that things are changing, not only in Switzerland, but are changing around Switzerland in other territories as well. In that context, certainty and predictable, attractive tax system is certainly an asset, an advantage which will play in favor of Switzerland. With that, I hand over to Laurens, who gives you an overview of the package which Switzerland had crafted and point out the reform measures in overview. Let's see that we can move it. Yeah.
Thank you, Armin, and let me start with what we call the magic triangle, which we think quite nicely illustrates, on the one hand, the drivers, but also on the other hand, the goals of Corporate Tax Reform 3. And let me start with the international acceptance. I mean, Armin has already mentioned it. Switzerland has been forced to abolish 5 so-called preferential tax regimes. The holding regime, the mixed company regime, the domiciliary regime, both based, or all the three based in the canton tax laws, and the tax practice along the principal taxation and the Swiss finance branch taxation. So Switzerland needs to get rid of that, and of course seeks alternatives which might be accepted internationally, but on the same hand also guarantee the international competitiveness. And when we are talking about international competitiveness in the tax area, it is of course almost always about attracting mobile income, mobile profits, i.e. Profits arising from financing activities, interest income, dividend income, profits arising from royalties, and to a certain extent also from trading activities. And last but not least, of course, all these measures must be financially affordable. We will not go into the deep with regard to the financial affordability. It's a very complex area. It's also a very political area because different layers are playing here together. It's about equalization between the cantons. It's also about equalization of financing potential lack of revenues between cantons and the federal government. So having said that, there were three main areas on which the reform project has been focusing. First, as I said already, it's about introducing new rules, new measures which are accepted within the EU or by the OECD. This is of course somehow shooting at moving targets because all the international developments keep going on. Nevertheless, and we will see that when we touch later on some of the measures in more detail, I think this goal has been well achieved by the proposed law. It became quite early, it became obvious that replacing the 5 before mentioned preferential regimes cannot only be done by introducing new measures. These 5 regimes were so attractive and so flexible that they cover so many different cases quite easily, that it would be impossible to find adequate measures covering all these, let's say, type of activities qualified under the 5 old regimes. So therefore, a reduction of cantonal corporate income tax rates is absolutely key. And I think also here what we have seen by the cantons which have announced their proposed cantonal laws, it's moving absolutely in the right direction. The third element, that's the removal of certain tax obstacles. I refer here mainly to the issuance stamp duty and equity, has not been fully achieved yet. But nevertheless, overall, I think all the 3 goals have been well achieved, and we are confident that this gives a good basis also then for the public vote. So let us have a look at what has been constructed under the roof of Corporate Tax Reform 3. We always talk a bit about the temple. Of course, we have the solid fundament, which is basically the hoped outcome of the whole reform. You find that at the very bottom, it's really about sustainability for Switzerland. Being competitive, keeping attractiveness for jobs in an internationally accepted environment, creating legal certainty and security for investment, that's what we are benefiting from if this reform can be implemented. We can classify the proposed changes into 3 categories, and let me start with the one on which we will not further go into the details. That's called here the other measures. You find it on the right hand side of the temple. That's mainly about financing the whole reform. Jumping just to the very left of the temple, you see here the main measures and we will come to them in details later. At federal income tax level, it's the notional interest deduction on equity, and it's the possibility of stepping up hidden reserves when entering into Switzerland. A very important element of the whole reform is, of course, the changes which are enabled for the cantons within the cantonal harmonization law. The cantonal harmonization law is basically the framework law giving guidance and framework to the cantons how to amend or to implement some measures in their cantonal law. Here it's about R&D privilegiation from a tax point of view, but it's also, and let me pick out these two things here separately, it's also about the adoption of modifications for the capital tax system. It will be on the one hand a lowering of the ordinary capital tax rates, which is in the discretion of each canton, of course, but it also grants the cantons the possibility to introduce a kind of a deduction based on the assets a company have, similar a bit to what is known under the participation exemption for dividend income, for example. And what needs to be mentioned as well, of course, is that there is, in order to make it, again, financially affordable, there is a kind of an overall cap on limitations, at least for cantonal purposes. 20% of the taxable income must really be subject to taxation at the end of the day. And you see separately this bright star shining above the whole temple. That's the reduction of the canton tax rates. This is really a very important measure because irrespective of the activities, irrespective of the size, irrespective of an international context of a company's activities, that's something every corporate taxpayer will take advantage during this reform. So it can be really summarized as a fundamental change of the Swiss corporate tax law. It's one of the most prestigious proposals Switzerland has seen in the financial sector over the last years, but with the good result that at the end of the day we are confident that the level of taxation might be really similar, close, or in some circumstances even better than it has been today. So if you look then at the timing, what is next? Armin has mentioned that in June the Parliament has finally decided on the package. Now the period is running to collect the 50,000 signatures to take a referendum, which has been launched by the Socialist Party and which most likely will be successful. That means their public vote becomes necessary on the whole package. It cannot be segregated, so it's either everything or nothing. This vote will be scheduled most likely around the weekend of the 12th of February 2017. The goal is to get those measures implemented as of tax period starting 1st of January 2019, the latest. This is also timing which applies for the cantons. So, of course, the cantons need to amend their tax law as well. And the timing here will be that most of them will wait until the vote has been made on the federal proposition, and then they will come up with the proposition how to amend and how to make it compatible with the harmonization law, how to amend their own cantonal law. In parallel, the government is already working on the guidance and on circular letters to, let's say, detail the implementation then of the measures, because the law in the good Swiss tradition of legislation is quite lean, the wording is lean. That means a lot of space for interpretation, which up to now is not clear yet, which also offers the opportunity, once the sounding will be opened on the proposed ordinance or circulars, also possibly to influence then the implementation as defined in those additional rules and circulars. But let's have now a closer look at the most important measures.
Yes, even though the Swiss law, as Lauren said, is principle-based and a lot of interpretation is still to be prepared in the ordinance, which will be published for consultation right after the successful passing of the popular vote mid-February next year. There is some insight, obviously, we can share during this webinar about the individual measures, and I will start with the innovation tax incentives. And you can see here there are two innovation tax incentives. We have on the left-hand side the input support, which is coming in the form of a R&D super deduction, which is voluntary for the cantons to implement. And you see on the right-hand side the output support, which comes in the form of the internationally accepted shape of a patent box, which is mandatory for the cantons to implement. Let's go briefly into some of the details. The main objective when putting these two measures into the reform package was to obviously retain existing mobile functions in Switzerland in the field of research and development and exploitation of intellectual property rights. And many Swiss-based hubs and headquarters do own intellectual property rights or drive research and development out of Switzerland, but also to attract new investments into Switzerland in the field of R&D and intellectual property exploitation. Switzerland obviously is aware that internationally we are not alone fighting and competing for research and development and innovative activities. We are aware that obviously Belgium, France, Ireland, Luxembourg, the Netherlands, and also the UK, etc. have similar patent box systems in place and need to revise them to bring them into conformity with the OECD requirements. By the way, the UK patent box system has served as a role model to craft the Swiss rules. In common for all these rules is that they require domestic innovation activities, i.e. research and development activities that are performed with nexus to the country. This holds true for both the Swiss patent box and the input deduction system. The mechanics are, if you look at the patent box, such that patent box income, intellectual property income, is separately allocated to a box, which, unlike in the UK, where this box income is taxed at a low rate, in Switzerland it is fully exempt. For the super deduction, the Parliament has set a limit that R&D can be relieved up and amount of 150% of actual R&D spent. With the patent box and the super deduction, we believe that Switzerland will be able to retain and strengthen its allocation attractiveness for innovative activities. You may ask yourself who can benefit from these measures. Obviously, all companies that own patents and copyrights, there I have to open a bracket. Not all software obviously will qualify. Its process behind the scenes still ongoing. Which types of software eventually will qualify for box treatment and which type of software will not qualify. We have all companies obviously that invest into R&D more generally that will benefit, and this irrespective of size of the company or industry the Swiss company is operating in. So these are measures that benefit multinational companies, but also do benefit quite a lot Swiss medium and small enterprises, which is a key important message to spread amongst the Swiss voters, that the measures will not just be gifts to the international businesses, but they will also very much benefit Swiss small and medium-sized enterprises. Now, in a nutshell, what is the notional interest deduction all about? Before I start, it has been a long way to actually get this measure into the reform package. Only 5 cantons actively supported these measures, others were either against the measure or neutral, and only in the last minute the Parliament could find a compromise to include this measure, which we think is will be very beneficial for Switzerland. The objective of the measure is to retain highly mobile finance activities already existing in Switzerland from relocating abroad, but also obviously attracting new finance activities, be it of existing multinational companies that have located these finance activities outside of Switzerland, or of new entrants into the Swiss market to do financing activities, and particularly group financing out of Switzerland. It's important to note that the notional interest deduction is not classified as harmful by neither the EU nor the OECD, and that obviously the notional interest deduction mechanism is somewhat known in a few countries, only you see them on the list on the slide. It's Belgium, Cyprus, Liechtenstein, and to some extent also Italy. However, it should be noted that other countries have found their ways to also attract financing activities with other incentives like the UK, Luxembourg, Netherlands and Ireland, the days of which, however, may be counted in the light of the OECD and EU developments. The notional interest deduction is also a very important measure that will allow to consolidate mobile activities in Switzerland in an easy way, which becomes very important as part of the BEPS agenda that requires substance to be placed in the locations where profits are allocated. We have some Swiss, we call it Swiss-Finnish specialties in the system. First of all, because of the parliamentary compromise, it's optional at the cantonal level, it's mandatory at federal level. And at cantonal level, it's linked to the decision by the canton to lift the partial taxation for private dividend income from today 50% to 60%. Some cantons have announced that they will definitely introduce the notional interest deduction like Zurich. Others like Basel-Land have decided not to take advantage of the system. The NIT is applied on the surplus equity, not on the full equity. Reason being that the benefit should not predominantly accrue for banks in Switzerland, but for other business, and the logic being that every company needs a certain minimum equity to be able to operate, and obviously any voluntary equity beyond that minimum could easily be replaced also by debt capital. If it was debt capital, then interest would become deductible. Why should then excess equity not also benefit from an interest deduction? The resulting effective tax rate for finance activities in Switzerland will likely range in the area of range of 3 to 6% for large financing volumes, and likely get closer to 8 to 10% for smaller financing volume. The mechanism is based on either the long-term federal bond rate, which is today actually below zero, or, and that's important for group financing activity, based on an arm's length notional interest rate, and that is will become attractive for companies. I just see there was a question coming in whether there is a list which cantons will accept the notional interest deduction. Yes and no. The list is pretty short, given not only few cantons have announced their plans in that regard. Other cantons are in the preparation to announcing these plans, and to have a comprehensive view, you should wait a few more months to have the full transparency on the cantonal plans. The other question about the negative rate for federal bonds, I have, I believe, answered that it is for group financing a arm's length rate that can be applied. So that's in short for the notional interest deduction, and I hand over to Lawrence for the next measure.
Thank you, Armin. So that's really a very interesting topic, which created a lot of headache when we assisted the working groups to draft then the new law. They do not want to go really technically into detail here. It's more about the principle, about the mechanism. So we prefer to speak, when we talk about this measure, about the treatment of hidden reserves in combination with the so-called tax status change. So you might ask, what is a tax status change? So a tax, or we understand under a tax status change, always if a corporate becomes liable to corporate taxation in Switzerland, or if its corporate tax liability ends. So therefore, the rules as defined for federal purposes apply really for companies entering, moving into Switzerland, and also to be mirrored, of course, when leaving Switzerland. I will just come in a minute how or what it means from a technical point of view, just in a nutshell then. But we have also other cases where we talk about status changes, and one of the most important one is, of course, the abolishment of the holding regime, of the mixed co regime, but also of the principal taxation. There we don't have, let's say, a real beginning of tax liability in Switzerland, but we have a fundamental change of the way how income gets taxed. And easily can be illustrated with a holding company. So for cantonal purposes, the income tax rate for a holding company was or still is nil. It's 0%, of course. So all the hidden reserves which have been built up by a company when this company was treated as a holding company, once they would be realized, assuming the company still would be a holding company and therefore would not suffer any cantonal income tax. So basically all these reserves could realized in a tax-free way. However, since these regimes need to be abolished in 2019, the latest, the up to then untaxed reserves will suffer a heavy increase in its taxation. And this is considered as being in contradiction to the fundamental principles of taxation as defined in the Swiss Constitution. So rules need to be defined in order to avoid this so-called fiscal shock. So the tax status change is a very important element to smoothen the transition from companies which are forced by law to exit their cantonal tax or also their federal tax privileges when we talk about a principle. So the intention is really to ensure a fair tax burden for the companies, but also to guarantee a kind of a stable tax revenue and granting certainty to the governments, because basically it is a kind of a transition, talking now about the mixed co and the holding companies or the principals becoming ordinary tax. It's a kind of a transition making the period when they had this privileged taxation under the old regime, basically having the smooth transition into the ordinary taxation systems. So the idea is really that these taxpayers are basically either allowed to step up in the tax balance sheet assets or also liabilities and to create, let's say, hidden reserves or to disclose hidden reserves in their tax balance sheet, allowing for future depreciations. There is a other way how to deal with that. That's the way who has been chosen by the legislator for the companies exiting the canton regimes. It's a kind of a two-rate approach, that you would allocate a certain income which is due to the realization of all hidden reserves to a basket, to a separate basket which will be subject to a lower taxation. So this is a very important rule, especially for those companies which probably would not benefit from either the patent box or the NID deductions. And it's also an important measure to become attractive for companies wanting to relocate to Switzerland. So let's have a glimpse at the last, let's say, measures which we want to elaborate a bit further in detail. Of course, it is the reduction of the cantonal tax rates. And when we talk again here, it's not only about the income tax rates. You see basically what has been communicated by most of the cantons so far. And please bear in mind, this is just, let's say, kind of a letter of intention, because it needs to be formalized in the canton law, and then, of course, this canton law must pass a vote either in the parliament or also, let's say, a public vote similar to the one we're going to have on the federal law next February. But it's an indication where the cantons want to go with their tax rate. And when I talk about the tax rate, then it's important to know we are talking here about the effective tax rate, i.e. that's the tax rate to be applied on the profit before tax. And it is the combined tax rate, i.e. the tax rate at federal, income, cantonal and communal level. So we see that there is quite a significant move in many cantons. If you take, for example, Vaud, which is an interesting case anyway, because they passed the public vote already, had a huge majority in favor of the significant reduction of the tax rate. This is probably also due because they cleverly structured the package, so they combined the reduction for the corporate tax rate with quite attractive advantages for mid and lower class income. So a second remark which is important to know, these tax rates, they can be reduced further down if they are applied, of course, in combination with special measures like the notional interest deduction or the patent box. And I think, Armin, it's fair to say that if really a company can fully leverage those initial measures, it is reasonable to expect an overall effective tax rate, depending on the canton, in the range between 9 and probably 11, in the worst case, 11%.
Even in Zurich, where you see that the tax rate reduction is not that significant from 21 to 18%, applying the measures which we have explained before, and obviously depending on the attributes of the individual company, where they can make maximum use of these measures, will allow in Zurich a tax rate of as low as 10.1%, and the notional interest deduction is not even included in that calculation.
And just to, again, to mention also the changes in the ordinary tax rates for the capital tax. This is also a measure which will be beneficial for all the taxpayers, also, let's say, for the small and medium-sized enterprises. And this measure will be combined in most of the cantons with a kind of a participation deduction, allowing a further deduction depending on the ratio of, let's say, participations, loans and patents towards the total assets. So if you look in the future, then Switzerland, and Armin has mentioned this already, will definitely remain a very attractive place to locate an IP company. The effective tax rate would, even after the abolishment of the mixed co-regime, be as attractive as, let's say, 10%. It can be combined probably with the so-called Stepup, i.e. that's the mechanics of undisclosing for tax purposes hidden reserves. There will be maybe some restrictions compared to today with regard to the type of IP. Armin has mentioned that before as well. So not every IP would be accessible to the box, of course. And it's also worth mentioning that, of course, there must be some further developing activities related to this IP. Otherwise, the benefits of the box would not really be applicable. But just it's important to bear in mind that these developments, that's not only, let's say, tightening a bit the rules for Switzerland when it comes to the tax treatment of IP, but this is something which is, as an outflow of international developments, of course, also applicable in other jurisdictions. Then probably to go to the next, let's say, typical Swiss structure, which again will remain attractive in the future, even if the today well-known taxation privilege as a principal company needs to be given up by 2019, the latest as well. Nevertheless, if substance can be bundled in Switzerland as a regional hub, it can be possible to, let's say, allocate a lot of the movable profit, a lot of the margin to a low tax environment like Switzerland is, given there is enough substance, of course, in Switzerland with regard to IP, i.e. patents, and with regard also to key decision makers, because these two elements are basically the main driver behind the allocation of the big portion of what we could call so-called residual profit or the margin on a centralized business model. And maybe as a closing remark to these type of, let's say, companies which again will remain attractive also under Corporate Tax Reform 3, just bear in mind that currently for 16, 17 and 18 the old taxation models are still applicable. So maybe time-wise we have to differentiate. There is a small window within the next, let's say, 2 years to still probably apply the old regimes and then transition smoothly into the equally attractive new world. And having that said, I think that's the good handover to look where Switzerland is from an international comparison perspective.
Now, where is Switzerland? I claim Switzerland to be the single most attractive location in Europe and beyond. Here is the map in Europe, and what you see is obviously Switzerland marked in yellow there in the heart of Europe. You see sort of 3 sort of clusters of countries. You see the cluster with the attractive tax rates, somewhat similar to the Swiss future and current tax rates, with Cyprus being an example of a 10% effective tax rate country, or the famous Ireland with its 12.5%. There are only very few, and they are sometimes in places where other economic factors may not be as favorable to actually invest a lot in and do a lot of sort of activities there. Then you have sort of the middle cluster, I would say. These are the countries like the UK, also the Benelux, where we see a tax rate in the 20s, with the UK gradually moving lower to announced 18% by 2020, or perhaps even 17, or the Benelux countries, which are rather starting at 25 type percentage, with Belgium announced some tentative plans to see whether they can lower it to 20%. This sort of cluster is already twice as expensive from an ETR perspective, like the best locations in Switzerland. And then you have, I would call them the hardliner territories, starting with Germany, but then also France and Italy, which are at the 30s plus in terms of effective tax rate, and therefore about 3 times more expensive from a tax perspective than Switzerland. So that's the competitive landscape. If we inward look at Switzerland's position as an attractive tax location, then as Laurens have pointed out, the old tax regimes, they are still open for business during sort of the next 2+ years. So Switzerland is open to welcome new investments into Switzerland, apply the current regimes, and as you have heard from Laurens with the Stepup, there will be a transition period of 5 to 10 years during which effectively the current tax rate will continue to prevail also thereafter. And who can claim, if you look from a local country perspective, that type of low tax certainty for a period of sort of 7 to 12 years. Then, as we also said, international acceptance, the new measures are in line with the international rules. So Switzerland should be on the safe side and not be exposed to sort of blacklisting rhetorics. We have a stable tax system. It took us about 7.5 years to get to the point where we are today. From the start of crafting the bill, it will take us another 2 years or so before it will become effective, which also means that any further changes thereafter will not be done overnight, and that distinguishes Switzerland quite a bit from other countries which have a habit of changing their tax rules sort of in annual intervals. It is competitive, we think, as I said before. It is also a substance supporting, i.e. the Swiss environment has for long attracted a number of direct investments, but also facilitated homegrown Swiss entities to successfully globalize. And we have a few other tax factors which the tax technicians typically like: the absence of CFC rules, no intention to introduce such, no strict transfer pricing rules, even though Switzerland follows obviously the OECD transfer pricing guidelines, but no documentation requirements, no formal efforts required in that sense, and Switzerland is committed to the OECD standards. This is sort of the tax attractiveness points, but they should be coupled with other attractiveness points, like the well-educated workforce, like the well-established infrastructure, the reliability of Swiss infrastructure, stable legal system, labor law system, also, even though we have some small areas where Switzerland also can still improve. We have a low government debt level, which is very important to actually fund this low tax environment, which is not for granted in a lot of other territories. And we have world-renowned universities that typically rank quite high on the university rankings, which means we have a lot of innovative resources in Switzerland that help businesses to succeed. It's also about we have a claim, namely to spread the word, especially those of you who are based in Switzerland, spread the word amongst those colleagues, friends you have in Switzerland, to eventually sort of go and vote positively for corporate tax reforms. It is a technical reform, which is typically a challenge in front of the public. The majority of the parties do really support the reform. The majority of the cantons also support it. So it is clear that it must succeed, but without having all the interested parties voting at the end of the day, we have to mobilize all the forces here. And that's a plea to you all. Please stand up in Switzerland and go and put a positive vote forward. Now that's from a Swiss perspective. We have obviously the environment in Europe that is exposed to challenges. I mentioned the state aid debate. You see here, and I'm not going into details, but I like the pictures. They are actually coming from the EU Commission. They have put these nice charts together to illustrate what the state aid cases, including but not only Apple, Fiat, McDonald's and Starbucks, are all about. And even though you see the Swiss flags in two of them, it is not the Swiss tax system that is in the heart of the challenge here. It is the EU tax system which is in the heart of the challenge. But it shows that these multinationals have found Switzerland to be attractive to form some sort of a role in their business models also. I get the signal that I have not more than 5 minutes left, so bear with me if I sort of rush through the more sort of marketing promotion oriented slides which you see here. I do it really briefly. You see, from our perspective, Switzerland is a preferred location for management activity. It's a traditional hub and headquarters location. Many American, but also Asian and European multinationals have found their way to Switzerland to create regional hub European centers here in Switzerland. And obviously, as I said, multinationals have homegrown out of Switzerland successfully and globalized. It's a preferred location also for people to work here. The high quality of life we hear often from expatriates is clearly distinguished in Switzerland from other places. We have special support beyond the tax rules from the cantons. This includes tax holidays, which may be available if a business is creating new jobs. In some areas, even federal tax holidays are possible. We have an excellent treaty network with close to 100 tax treaties. We have tax-neutral reorganization provisions, and above all, and that distinguishes Switzerland from most other countries, also we have a unique relationship with the tax authorities. It is sort of a cordial relationship where the tax authorities consider businesses as their clients and not vice versa. And obviously the ruling system is well known in Switzerland. It's designed to provide upfront certainty on the interpretation of existing tax rules. I will sort of not extend, because this is not my home turf, on the legal stability driven by the benefits of the democracy and political system in Switzerland, but it is clear that the lengthy process will create consensus for new reform measures, and this consensus is then fully supported by the Swiss political level, by the government level, the administration, and also the citizens, and creates that unique environment of stable framework for doing business in. Before we conclude, I would like to ask Laurence quickly what is next, because the Swiss Corporate Tax Reform 3, even though being the most important milestone in the tax arena in Switzerland for the last 30 years or so, the program will continue with further changes. Laurence, can you shed some light what is on the horizon there?
Yeah, so I'm happy to do so. For the sake of time, I will be very brief here. The issued stamp tax on equity, the abolition, which basically has been a part of the reform package, out for some tactical reasons, it has been carved out again. It will be a separate bill. Probably the same could happen to the tonnage tax, which at least for a country like Switzerland, not being at the seaside, seems to be rather a funny tax. So just one word here, it's not a separate tax for the shipping industry, shipping business, but it's rather the way how to determine the taxable profit, which might be different from, let's say, other industries. It was quite a fight during the discussions for Corporate Tax Reform 3 in the Parliament. Most likely can be integrated in a separate bill as well. But in parallel to that, there are discussions on an adoption of the withholding tax law to fight against the heavily criticized, very formalistic practice the Swiss Federal Tax Authorities has applied in the recent years on the so-called notification procedure. So that should give some advantages back, which we seem to have lost in that area. And there are also further topics probably on the agenda, like a replacement of the withholding tax system or some technical amendments of the participation relief.
That brings us to my closing statement, and I would like to repeat what I said at the beginning. Switzerland, from our perspective, has been known as a very attractive tax and business location for many decades. With Corporate Tax Reform 3, Switzerland is to stay, and I say it's the single most attractive tax and business location in Europe and beyond. Please remember this, and obviously we are still here ready to take some questions, and Liv, I believe some questions have come in, which we can answer now.
Yes, unfortunately we're coming to an end soon. One question is, the tax rate for the Swiss and international companies the same?
Would you like to?
Legally, yes, of course, but as we have elaborated, depending on, let's say, the interaction between the different measures, which might be applicable for one country, but which might not be applicable for another company, it can lead, as a result, to a different tax rate. But from a legal standpoint, the tax rate as such, as well as the measures on which we have elaborated, they are equally open and accessible both to Swiss and to, let's say, international companies.
If we talk about international and Swiss companies, that's one thing, but if we talk about small and big companies, is there a clear winner or loser perspective?
There are differences, and if you look at the sort of absolute amount of benefit, typically international businesses will benefit much more. So quantitatively, their benefits will be greater. If you look mechanically, then given the Nexus formula that the OECD has imposed, obviously it makes it easier for small and medium-sized enterprises to demonstrate that their R&D efforts have been exercised in Switzerland domestically, whereas for some multinationals with dispersed R&D centers, they will have to see a reduction in their Nexus formula because not all their R&D is actually performed in Switzerland itself.
There is another question from the audience. What about unilateral measures against taxation below a certain rate? For example, no tax deductibility if not subject to at least 10%.
Very good question. This is a phenomenon which has been started to some extent with especially France and Austria. Fortunately, it has not sort of mushroomed much further meantime, because I guess other countries have come to the conclusion that actually these unilateral changes and requirements are violating the treaty principles. But nevertheless, they exist for a few countries, as I said, like Austria. We deal with that challenge already today because our status companies do suffer or do benefit from a rate which is typically below 10%. There are ways with the cantonal tax authorities to actually carve the respective income out of the tax basis and subject that part of the income to a higher rate. But that will also be possible under the new corporate tax reform 3 regimes. Please note that the measures are actually sort of voluntary measures for the company, so they can claim the deductions and reliefs, but it's not a must. I hope that sort of answers this question satisfactorily too.
So I would like to conclude now because unfortunately the webinar has come to an end, pointing out a few organizational things again. But foremost and first, I would like to thank you for the very interesting presentation. You will have the chance to receive the presentation via email, those of you who have applied. Also, you will be able to watch the webinar once more afterwards. And please don't forget to answer our question and answer form for how we did with the webinar and if you liked it or not. Thank you very much.
And if there would be special questions to the speakers, they could be found sort of as well.
Yes. Thank you very much. Hope to see you again and have a nice day.